Hello and a warm welcome to Econoday Unplugged on Tuesday, the 6th of July 2021. Mark Pender's stateside and I'm Jeremy Hawkins in London, where it's pretty safe to say that most market participants are much more focused on England's Euro semi-final match against Denmark tomorrow than they are on what's actually happening to market asset prices. And to be fair, markets have a pretty relaxed feel about them in this holiday shortened week, and by and large, volatility levels remain pretty low. Nonetheless, last week's June US payroll achieved its steepest rise in, 10 months, and much of economic data generally, as well as OPEC's failure yesterday to agree on higher oil output, still carry inflation risk as the recovery in demand continues to outpace supply. Indeed, amongst the major central banks earlier today, the Reserve Bank of Australia joined the Bank of Canada in deciding that the time has now arrived to start tapering its quantitative easing programme. That said, in Europe, some of the early hard data for May have fallen well short of what the surveys have been suggesting. And it's going to be interesting to see whether this disconnect is sustained and ultimately equates with a disappointingly slow recovery from the COVID crisis. In any event, let's start across the pond with Mark. So did the employment data tell us anything new about how the US economy is shaping up?
It did. For the first time in several months, the 850,000 rise in non-farm payrolls exceeded Canada's forecast, which was just over 700,000. The results had sharply underperformed. So it is suggesting that hiring is finally accelerating, that the lack of ability to find qualified workers is diminishing. And this goes in line with what the Federal Reserve has been saying, that as vaccinations pick up, as concerns of COVID in the workplace decrease, and as generous emergency unemployment benefits roll off, which they're beginning to do, you'll get an acceleration in payrolls. But to go back to your point, and we're going to be discussing in part how the business surveys are not correlating that well with the actual results. And I guess, Jeremy, you're going to say in Europe, which they have exceeded actual results. Here, they haven't exceeded it to the same degree, but we just had the ISM services report this morning, and it showed no change, actually slight contraction in their employment reading. Now, the ISM services employment index had been once, and maybe now less so, used as a proxy for when it comes out before the employment report of what to expect, because it takes a broad range of companies, a couple hundred a month, maybe 300 a month, through the services economy, which is the bulk of the economy, and it gives a index on the employment. Well, this index would have suggested an under maybe a 500,000, no change in payrolls. The prior was 559,000 or 583,000, something below what we expected. So I know this doesn't fit in exactly with the point we're going to try to make here, but that they've been in business surveys here in the U.S., especially the regional manufacturing surveys, have been through the roof, and if those would correlate to actual factory orders and actual industrial production, the Fed would have already started raising rates. But I guess what I'm trying to say is that business surveys are limited in their sample size and limited in and the respondents who go ahead and offer their monthly suggestions or their monthly indications, and so maybe we should take them more with a grain of salt. But to pass it on to you, Jeremy, what's interesting about Europe is the consistency through all the different reports. They've all been so elevated. Have they been coming down at all?
Yeah, you're right. Just quickly before we move on to Europe, can I ask you, one thing which is a feature of Europe when it comes to PMIs is that, notwithstanding the fact that we're going to have a little bit of a go at them probably here, because they have the correlation between the PMIs and the hard data hasn't been that great of late. But when we get to the next ECB statement or the Bank of England statement, we're going to see these PMIs being mentioned probably in the first or second paragraphs as a current indicator of what's going on. Is that going to happen when we get the FOMC minutes out of the Fed this week?
That's a big separation between Europe and the US, is the amount of emphasis they put on these business surveys, especially the PMIs in Europe. And I guess that just goes down to maybe a lack of timely data that Europe has compared to the US. I remember here back in the 90s when Alan Greenspan, who was a big US data
So, yeah.
aficionado or whatever, he at that time, it was the National Association of Purchasing Managers, and now it's the Institute for Supply Management. But he got on in his testimony in Congress, and he started pointing out the importance of the NAPM in his own work. And he used to call up the chair people who organized these surveys before they released them. He was given an embargoed copy, and he used to talk to them on the phone about the results of these surveys. So that was kind of the opening for us in the 90s with these business surveys, even though they had been around quite a long time. The Philadelphia survey has been around since the 60s. The Chicago PMI has been around since the 70s. But as far as policy making at that level, it wasn't to that degree. It is occasionally mentioned, certainly, but not anywhere in like to actually ground future policy or the current assessment of the economy. And also we can go back to high frequency data, which is a little bit different, where this is the new thing where you're looking at Google rates and these kinds of things. Jerome Powell had pointed to those at the beginning of the pandemic closures as important indications, but that emphasis has already faded, and now these are not being mentioned anymore because at the emergency point he was looking for the very most timely data he could get, and that's what these business surveys. The business surveys give you timely data. Like we just got the ISM for June, so the first June readings. Well, we've already had or I guess we'll get job. We've already had jobless claim. We've already had the employment report for June. But some of these, how about the PMIs? Okay, so they have their mid-month for June came out at mid-month, and the Philadelphia Fed came out at mid-month in June. So they're a few weeks ahead of the official data. But like the official data for June, the most important one is employment, and that's already out. So that actually beat the business survey. Now, so let's ask you for Europe now, how is there, I know that German unemployment seems to come out very fast, and the CPIs come out very, very fast in Europe. But other than that, is it a lack of timely data that
it is yeah, you're right, exactly. It is an issue. For example, we're just about now starting to get May data, the first of the hard May data, which really just shows you how far behind you are in terms of statistics. So we just had May retail sales, which actually turned out to be very good as far as the Eurozone was concerned. But in terms of industrial production from the output side of it, we still got over a week or so to wait for that. So that the hard data really are very tardy in being released out of Europe. So it does leave policymakers, to be fair to them, scratching their heads really trying to work out what's going on. So then, okay, getting back to this, just in summary, I mean, the good news from the Eurozone economy is that it is recovering, but while demand appears to be doing particularly well, and retail sales today exceeded expectations quite comfortably, output is not holding up as well as the PMI surveys might suggest, and that's particularly true of manufacturing, where the sector PMIs have been overly bullish for quite a few months now, and that performance gap is going to be particularly important, of course, for what happens to inflation. So just to lob a few numbers into the pot, and we have to go back a couple of months just so we can actually compare the hard data. But we look at France, for example, the headline PMI there in April came in at 58.9. It was 59.4 in May. But in the same months, industrial production rose just 0.1%. So that'll be in April, and in May fell 0.3%. Of course, these PMI numbers are, by European standards, are pretty well through the roof. Same thing in Germany, and we don't even have the German May industrial production data yet. We'll get them tomorrow. But the April figure was all the way up at 66.2, which really means output is completely through the roof. And in the same month, according to the hard data, though, industrial production actually fell 1% on the month. Now, I mean, part of this clearly is due to how these things are constructed within the European PMIs from market, vendor delivery times, which we know are getting longer and longer due to oil capacity problems and shortages of raw materials at the moment. They carried away to 15%. Stocks of purchases, which have also been accelerated because all these firms are trying to preempt further production problems down the road by actually getting their inputs on board now. They've been rising sharply and they're up 10%. So essentially 25% of the index is being pushed up by variables which are really giving completely the wrong signal. But now we can say, okay, well, that's missing the point because you're talking about overall activity. We're really supposed to be concentrating on production. But if you look at the production sides as well, it's a similar sort of story whereby on the whole, these the PMI sub-indices are too strong. So again, just look at April in Germany, the manufacturing output sub-index was up at 67.6, but output actually fell 1% that month. Similarly, France in the same month, it was 58.7 for the manufacturing PMI sub-index, output fell 0.3%. Now, the Eurozone correlation as a whole is rather better than that, but it's still, coming out these numbers which simply are not getting it. The actual numbers not getting anywhere close to what the PMI data are suggesting. And that's really been reflected, I think, more and more now in the way this demand and supply side balance is coming through. So, for example, if we look at what's happening in Germany, we got May German retail sales. They actually come out relatively early in the calendar as far as Europe's concerned. Now, if we compare May retail sales with where we were in February last year, so pre-pandemic level to give us a sensible base, then sales are actually up 3.9%. So if you like, the recovery in retail sales is more than complete. However, if we look at German industrial production, irrespective of what these PMIs might be saying, the hard data, and this is only as far as April, to be fair, so there is still a month to go to catch up with May, but it's down 5.6%. So in other words, the May data, the hard data for industrial production, will need to show a monthly increase of what, about 9.5% or so to catch up with retail sales. So demand is clearly easily outpacing what we're seeing coming through from the supply side. It's a similar sort of story if you look at UK. Again, May retail sales versus the February base of 2020 pre-pandemic. That's all the way up at 9.1%. But the recovery in UK industrial production, at least as far as April, that was still 3.1% short. So this huge gap between the two are going on. Now, it's interesting because if you look at the way the inflation numbers have been moving for these countries, then in Germany, if we look at the core rates, so it strips out some of the volatility caused by food and energy and the like. Inflation in Germany, core inflation in January, so at the start of this year is 1.4. It's now up at 1.9%. In the UK in January, core inflation here was 1.6%. It's now up at 2%. And you've got to think it's partly due to this imbalance between demand and supply. And so if you move across to Italy, where it's the other way round, where we've seen demand actually recovering quite slowly. So in April, retail sales in Italy were down 4.5% versus the February number, the pre-pandemic last year. Industrial production, though, was actually up 1.2%. So the recovery in supply has outpaced demand. And what's happened to inflation or core inflation? The beginning of this year is 0.8%, as the latest figures, which are actually June preliminary ones, is down at 0.3%. So I think, in many ways, what we can say, these PMIs are throwing out quite a misleading picture, really. Yes, they're capturing some of the bullish state we had, generally speaking, certainly in terms of consumer demand anyway, but they're giving a misleadingly firm picture of output. And it's the gap between the two, which is clearly going to be instrumental in how the inflation profile develops as we go through the rest of this year.
Interesting. Now, but the services surveys in Europe include a retail component.
They do, yeah, that's right. It's difficult because the problem we're looking at the services output side of the economy, as we don't really get any particular data coming through until we actually get the GDP accounts, and that's so late we don't have much to to compare with. But yes, I mean it does look. I mean, all we can say is that the service side of the PMIs and indeed other surveys like the big economic sentiment survey we get coming out from the European Commission, they've certainly pointed to a fairly significant recovery in certainly service sector activity during the course of the last couple of months or so, and that would seem to be consistent with what's going on with the with the retail sales side.
Well, and that's where, and let's look there. So let's look at the European consumer sentiment, consumer confidence readings as a substitute for actual, and they don't always correlate, of course, as a substitute, a business survey, a business type survey. Instead of asking businesses questions, these surveys ask actual consumers questions. We had the ZEW today, right? And no, but that's German analysts. But how we last week we had economic sentiment, was it?
Yeah,
The European
is a multi-year high in the headline index, again, which should be consistent with this, with a sharp recovery in economic output. But again, you kind of wonder if it's being biased up through some, some, if you like, from some false readings where, developments are giving the wrong impression, such
right.
as we mentioned earlier. Like, normally we talk about, you look at vendor delivery times, and if they're getting longer and longer, typically speaking, you think, aha, demand, if they're getting longer and longer, it's because they're working at full capacity. That means the economy is doing really well. Well, in this case, we know it isn't. It's simply because these producers, in some instances, are actually cutting back on production because they can't get the supply of inputs due to shortages of raw materials and shortages of freight containers and everything else which is interrupting these supply chains at the moment. So I think the bottom line to all this little lot, I suppose, is that as you were saying, you do have to be careful when you're looking at these surveys. Yes, you need to look at them because in many cases, particularly as far as Europe's concerned, it's the only sort of sense of what's going on reasonably currently that you're going to get because the hard numbers come through so late, but they can give misleading impressions. Perhaps just to round off, and it's interesting, we talked before about our economic consensus divergence indices, where if we look at France and Germany, which had been doing very well, the French index now is down at -11, Germans at -12. Now, that's not a huge negative reading, but it does suggest that, the forecasters have been started to become too optimistic about the pace of recovery. And that may perhaps be because, typically speaking, when you trying to put the forecast together, these PMIs and the surveys will be a factor in what you decide about what you're going to forecast for industrial production or whatever it may be. And it may perhaps be some spin-off from the fact that the PMIs themselves are giving misleadingly optimistic readings on the output side, that these ECDIs are starting to go negative.
Okay, well now let's talk about the hard methodology of these surveys. So are we getting a recovery a COVID reopening exuberance in these numbers? Now, when you ask a consumer, are you more optimistic now than you were this time last month? Yeah, I guess so. And you ask a business, or do you have more orders this time than last month? There's two different responses. Well, let me go check my books, or I'll just check the oh, definitely. So we don't know the degree, the exactitude that the business surveys the respondents are putting, what kind of effort they're putting into these month to month readings. And that's why they're month to month in these reports, because you can't, if you ask them what was it like last year, then they would definitely have to go back to their books. They could ask that question, and that would guarantee that they would have to go back to the books because the memory isn't that long. But a month, part of the reason they do the month to month is it gives you a little slippage there. It gets more more responses in. So maybe we're getting business and also the consumer, we're getting an exuberance in these numbers that, thank God, Well,
I think that's right, and of course, one of the problems is we're trying to compare, diffusion indices with sort of hard data. And if you think about it, when you emerge from COVID, it would be presumably reasonably safe to assume that because demand's going up, almost every business is going to receive more demand now than it did previously during COVID. Therefore, taking at face value, you could imagine some of these PMIs almost coming in at 100%. Now, that may not be because demand's got, supply or demand's actually gone up a lot. It may simply be because more people are out there shopping and buying things. All these businesses are now selling 3 widgets rather than 2 widgets. Now, that doesn't matter in terms of how this index is constructed. It simply means that, yes, everyone's saying it's gone up, therefore PMI equals 100%. So I think when you get to these turning points, these inflections in what's going on, that the diffusion indices themselves, can start giving, misleadingly strong or indeed, weak impressions of what's actually happening.
Well, speak about 100. I mean, the prices paid, ISM's manufacturing survey came in at 90 something. That's almost the equivalent.
Wow, that
So,
is
yeah, all these, so the whole entire sample, and talk about bubbling inflation pressures, at the base of the economy. The ISM's almost entire sample said that prices in June were higher than they were in May. And, and the consumer side of the US picture is that inflation is, though elevated right now, whether month to month or especially year on year, it's slowing from the peaks we saw in April, which is good news. But if you look at the ISM, you wouldn't think that at all. I mean, you would think that, like you were saying, something's going to have to pass through to the consumer. Okay, well, shifting gears real quick, we had manufacturer orders from Germany this morning, and they fell 3.7%, which was not expected. The Econoday's consensus was for a 1.3% gain. Do you think that forecasters were using the PMIs? Or did the PMIs influence the forecasters to get this number so entirely wrong?
Well, yeah, I suppose to be fair to any forecaster, if you're given the job of trying to call German manufacturing orders on a month-on-month basis, then you have my sympathy, because it is a notoriously volatile series. But yes, it's certainly consistent with the fact, as you mentioned, the consensus was up 1.3%. It was down 3.7%, which is one of the biggest falls, or the second biggest fall we've seen over the last year or so. And why do you go for that? Well, you don't have a lot to hang your hat on when you're trying to forecast this number, but you do have the PMI. And if we look at the German PMI, and what did the orders part of it say? Well, guess what? It suggests that orders were growing at a historically extremely rapid rate. And yet, as you mentioned, quite clearly, the correlation between the two in this particular instance, and indeed for a number of months, it really has broken down. In the past, I should say, to defend the PMI guys, that with it across Europe, one reason why central banks do look at these PMI surveys, not just because they're up to date, but they've had a pretty good track record, at least calling the broader picture of what's been going on in manufacturing or the services sector, and indeed the overall composite output and its relationship with GDP. But there are quite clearly some issues at the moment. And I guess it's going to be interesting. We're going back to these central bankers, because I think if you look at the Bank of England now, we got the likes of Andy Haldane, the bank's chief economist, who's about to leave the bank fairly shortly. Now, he made comments last week, which I don't think impressed his boss, the governor, too much, saying that inflation is likely to move above 4%. And there's a risk of it getting out of control. And I think he's one of these guys who does take these surveys on board, is clearly getting more concerned about it. The likes of Andrew Bailey, the governor, who came out and said, no, don't worry about it. This is just the classic central bank line at the moment. This is just going to be a temporary blip, and it will soon start unwinding and going back down again. So it may be quite interesting, which of these FOMC or MPC members attach most weight to these surveys, and which perhaps tend to, well, okay, maybe, but we need to see the hard data first, that kind of approach.
Well, there's a little bit of cherry picking with the policymakers, and the ones they choose, the indicators they choose to justify their views at the moment. I have seen that in the past. Everyone, I guess, is guilty of that. And what did Darwin say? He was most acute to those indications that went against his thoughts, his assumptions. I'm not sure that economists.
I guess we can all have sympathy with
that.
As you say, you can choose the statistics to which fit your story and ignore the other ones. Yes. Okay. Right, what else have we got I should be mentioning from my side of the world then? UK, I should mention, I suppose it's going to be seen now as this kind of COVID experiment. As of yesterday, the Prime Minister announced that the so-called Freedom Day on July the 19th looks like it's still going to happen. So essentially, once we get to July the 19th, a couple of weeks away, as near as damn it, all social restrictions on the UK population will be ended. There will still be voluntary mask wearing as and where people see fit, but it's going to be voluntary. Now, they're doing this at a time when, hooray, the death rate is very low, and indeed hospitalizations are low. However, both of those are starting to drift up. And what is happening, and which is worrying the scientists, is that the Delta variant we talked about before, it has led to a huge increase in new COVID cases. Currently, we're running at a daily basis, around about 27, 28,000, something like that, which is the highest we've seen since February. And the new health minister himself admitted today that once we open up fully, there's a chance that that daily number could move up to 100,000. So this really is taking a big risk, and it's really a case of hoping that although the cases are almost inevitably going to go up, it's just a question of how far they go up, that the vaccines will keep the hospitalizations and more importantly, ultimately the death rates low enough that the kind of linkage between the two is ultimately broken. And then almost catching COVID won't matter because you won't get it because you've been fully vaccinated, or if you do get it, it'll be so mild that you almost don't notice it. But I think there's a lot of countries now which are looking across to the UK to see what happens here, with a view to determine whether they're going to open up abroad. The likes of Germany in particular has taken note about what's happening here, and Angela Merkel was making some not very polite noises to our Prime Minister of a G7 meeting about the UK opening up too soon, given the risk of this Delta. And indeed, as things currently stand, we're starting to see that the Delta variant now increasing quite sharply in the number of Eurozone countries, particularly Portugal and Spain. So it's, although COVID, we like to push it to one side, it's still going to be an issue. And who knows, that may be something which is going to influence, these business surveys. When we look at the PMIs, almost without exception, we've got business optimism about the year ahead being at least historically very high, if not at new time peaks. But as you mentioned, that German ZEW survey, which came out earlier on today, there was a fairly sharp decline in the expectations component. And some of that appears to be worries that this Delta variant is going to hit Germany in the same way it's, as it's hit the UK and might slow down the pace of recovery. So still watch this space, as they say.
Mm-hmm.
One other thing I should quickly mention on the UK, which has also been a true test, I suppose, of what the underlying picture of the UK economy is. The furlough support programme, which has been underpinning salaries for furloughed workers up to 80% or so of their wages, that was reduced down to 70% support from the beginning of July. This is the start of the phase out, and then that will be reduced by another 10% to 70% to 60% rather month after that, and of course it'll end once we get to the end of September time, and that's when we'll actually find out just how important this program has been in helping to keep down the unemployment rates. And again, I think one reason why the Bank of England is still cautious, or that's more hawkish, is still cautious about doing anything with tapering, is it wants to see what's going to happen to the jobs market once some of these support programs are pulled out. Because it may be, who knows, we start to see a big increase in unemployment and all of a sudden we're not back to square one again, but it does mean that the idea of tightening suddenly goes out the window. Okay, anything else I should mention? Yeah.
Well, the Merkel reference was to Wembley Stadium, no? And have there been a warning? They let too many fans in, and so is there going to be a COVID? Are people keeping their eye on when should we look for a COVID relation to football?
Well, I'll tell you what. It's interesting. The World Health Organization came out, was it yesterday or so, saying that just looking at Europe, and they're reckoning infections in Europe now, largely due to the Delta variant, they've increased by 10% in the latest week. And that was after 2 months of solid decline we talked about before on the podcast. And they really are concerned about the risk we've got a whole new wave of cases coming through. And they're suggesting that this Euro 2020 championship, which is partly at Wembley in London, but it's also dotted around Europe as well, where these matches are being held, could act as a super spreader. So, the vaccination rate within Europe and UK is pretty good. European Union in general is pretty decent now, but it's mainly on the western side of it. But the eastern side of Europe, the vaccination rates there are still hopelessly low. I mean, Russia, for example, where they now have record daily cases of COVID, and again, I think it's mainly Delta, their vaccination rate is only, 17%, I think, of the population have had a single shot so far. So they're miles behind where they want to be. So I think, give it, a couple of weeks or so after the championship ends, and it's going to be very interesting what happens to the European COVID cases, because already people are warning about there could be a new worst case to come. We start seeing these cases going through the roof again. So it's going to be, let's say, an interesting time to watch them, but I just hope that the numbers stay down as they are at the moment. Okie dokie. Anything else from your side?
No, I think that does it.
Yeah, I think we've probably been prattling on for long enough as usual. Okay, then, great. Let's wind it up for this week then. So on behalf of Mark and myself, thanks as ever for listening. We'll be back next week, so please do join us then. And in the meantime, you can find all the key market moving data and events listed, as always, and analysed in Econday's global economic calendar. We'll see you next time. Bye for now.